Hey, everybody. Welcome to the Daily Bread podcast. I am here with the founder of Fiat DAO, Max Fiege, repeat guest. How are you doing today, Max?
I'm good, David. Thanks for having me back.
So we had planned this like a month ago, I think, on the schedule. And obviously a lot of stuff has happened in the last week or so. So you are the fortunate guest that gets to come on and talk about it first. So how have the last 2 weeks been for you?
Well, luckily, I feel like the DeFi space was always a bit more untrusting of CeFi platforms, right? So I didn't get caught up in FTX or BlockFi or Genesis, and at this rate, maybe Gemini tomorrow. So I personally survived, but yeah, it's just really heartbreaking to see the stories. People that lost it all, or just even Project Treasuries, right? Got nailed by this stuff. So yeah, personally I love it, but I think the industry, especially whatever regulatory repercussions come of it, I don't think anyone's out of the woods, regardless if they got a direct hit or not.
Last time you were on, we talked a good bit about regulations. That was, I think, 6 months ago or so. What anything you've changed your mind on, or I'm assuming you think things are probably worse now, but where do you think we stand regulatory wise with crypto?
Well, in my unprofessional opinion, I'm personally expecting probably some significant overreach in whatever regulatory fallout occurs from this. I think it's a really low-hanging fruit for regulators to go after, given what happened, just from the fact that this was all offshore. It did impact Americans, even though Americans supposedly, weren't using the platform. And how it impacted American LP money in the funds that were using it offshore, right? So I think even though it was a CeFi issue, it probably does accelerate any of the regulatory concerns people may have had about DeFi. I'm sure will be collateral damage in however this shakes out. So I guess to boil down my thoughts on that, I do think the regulatory response will probably be positive for traditional institutions getting into crypto, right? Like this offshore kind of standard, I don't think has a real future. But while all this was shaking out, right, I like BNY Mellon and trying to think who else had a headline. Well, BNY Mellon's the one that comes to mind, right? But it's very clear to me that things like BTC and will be supported in the traditional banking stack at some point or another. It's going to take a while, but the tech is finally there, the enterprise grade stuff. And I think if you follow any of the Bank of International Settlements type stuff, that really nerdy, wonky side of banking regulation, they're gearing up for how does a bank carry Bitcoin on its balance sheet? So for them, this is great, right? All the people that built the trading engines and marketplaces that supported crypto over the past 10 years, they're all blowing themselves up. And now the TradFi vultures come in, and basically inherit their work, but in a regulated fashion. So that's one half, right? And then the DeFi half, I think, gets the shorter end of the stick. Because yeah, obviously we're building things that are, meant to deal with the issues that came up in the whole FTX blow up, right? This basic concept of where are my deposits going? Who has my collateral? Who are the counterparties, right? It's that type of stuff that resulted in these blowups, and DeFi addresses all of that. But as unregulated financial platforms, it just does not strike me as being super conducive to getting the good side of any one regulator at this point.
Yeah, it's really a bummer that the US, I know FTX US ended up getting affected in the end, but at least those first few days, if you had money on FTX US, you were to get it out. And it's it really sucks that unfortunately the regulations are what protected people, because they had to, the FTX US books were regulated completely differently than the FTX.com books. And it gives them like tons of ammunition basically to like be like, see, look at this. And yeah, it's an interesting situation, because you could also argue that, well, all of this happened because you forced all of these exchanges to go offshore because the US was so unlenient on everything. Um, it's really a bummer. Of course, I don't think that most Congress people who are going to be trying to shove regulation down are really going to take the other side. They're going to say, "Oh no, we need to regulate the hell out of this." I do agree with you though. Like, I think I've said this a couple times on the podcast when you mentioned like other banks getting ready for custody and management. Arthur Hayes wrote an article like probably back in March or April this year, and he mentioned, like, it was the one where people have read his articles where he's like on a skiing trip or something with some finance people, and he said that, you know, he doesn't really like to talk about crypto with them, but like they started talking and they kind of all were like, oh yeah, we don't touch crypto, you know, like that's very dangerous, blah blah blah. And then he kind of was like, yeah, until you have products for it and you're making money from it, right? And then you'll recommend it to all your clients. And they kind of wink, wink, like, yeah, basically. So that's when I think we will shift tune. Like, I know the meme of institutions are coming has been around forever in crypto, but I think it's actually happening. And I think next cycle, whatever, you know, whatever that means necessarily, but next cycle we will have real institutions. Like, from your side, obviously with Fiat DAO, you guys think about this a lot, right? Like, how do you kind of position yourself as a DeFi protocol, knowing that there's going to be a lot of changes in the next couple of years?
Yeah, I mean, I think really taking that word to heart, you know, protocol is probably the most important thing you can do, right? Because today a DeFi protocol facilitates transactions between users who, you know, aren't KYC beyond just a geo block on a front end, right? But that doesn't mean in the future it can't be the custody trading accounts of users at centralized exchanges, right? I do think what's getting built in DeFi today can lay the groundwork for you know, regulated financial institutions to use these systems, very much like they use, you know, whether it's Swift for actual banking transactions, or if it's something a bit less technical, like oh, I'm blanking, but you know how there's like international standards for how to structure a swap agreement, stuff like that. And so similarly, like, I do think that's where the future of DeFi protocols could lie. At the same time, you know, maybe you make the argument for a splintering of financial systems, where there's the US regulated system and then there's the, you know, everything else system. Because I mean, the even before crypto became, you know, the scale it is today, the kind of increasing amount of US regulation on international finance was driving like international banking relationships downwards, right? I think correspondent banking is like the key phrase for that type of assessment. So that was a trend that was already underway, regardless of, you know, the future of stable coins, the future of DeFi, right?
Could you give an example of that for people who don't know?
Sure. So basically, the US has always had kind of a tradition of like pretty aggressive banking regulation, right? Bank Secrecy Act is from the 70s. Things accelerated with the kind of like the post 9/11, you know, stuff, post 2008 stuff. And so if you are an international bank, over the past 2 decades, the costs of taking on US customers or interfacing with US money have just gone up dramatically, like your compliance department costs, basically. And that's happened at the same time as interest rates have been dropping. So if you're a bank in Indonesia, for example, you know, your revenues are coming down. Granted, I might get nerd sniped. I don't know if the Indonesian interest rates have followed suit with everyone else, but right, the point still stands for most international banks. Their compliance costs have gone up, their revenues have come down. And so when we talk about correspondent banking, correspondent banks are basically the foreign banks that are approved to interface with American banks, and then, you know, kind of facilitate regional stuff that goes in between there and the US, to put it very simply. And so the number of correspondent banking relationships has been declining, I think, since the mid-2000s, after 2008 in particular, because the compliance costs are just too high. And you see stories about that, especially with like US expats, right? Like I think if you try and go to Switzerland now and you try to open a bank account, they'll just tell you no, because they don't want to deal with it. Yeah. So that's a trend that's been happening before crypto, and DeFi can definitely accelerate something like that. But you know, I think the funniest thing for me as like, you know, someone who's working on DeFi projects is the day-to-day stuff is like very dry, right? Like we are writing code, posting it on GitHub, deploying it on Ethereum, and it's just like very anticlimactic. But it does elicit such a like vehement response from the powers that be because of, you know, the implications of it at scale. So there is that like level of disconnect. It sounds a little silly to be talking about parallel financial systems when, you know, DeFi hasn't scaled beyond facilitating leverage for crypto traders at this point. But that's also one way things can play out, right? So I'm ambivalent. I personally just kind of like have this mantra of, you know, you build in good faith, you don't try and hide anything. And there's so much path dependence in all of this that you just have to kind of roll with, you know, what blows up where and how things generally go. And I think that's what ends up deciding the future of DeFi, right? In a nutshell, nothing's a given.
Yeah, I definitely agree with you that there will be probably like a outside US and inside US system. My question would be, do you think US citizens will be able to access the outside at all?
I think that comes down to a project by project basis, right? Like if you are a non-US citizen who's building a DeFi protocol and you do it anonymously, and you know, maybe in a couple of years we really have the tools for that code to be hosted in a censorship resistant manner and all that jazz, then, you know, US citizens would still find ways to access those platforms. I don't see us rolling out a great firewall anytime soon here in the US. So I don't think it's something you can fight, right? Like it's unless we were talking about like government intervention in the validator set, you know, when it comes to Ethereum. I just think it's a losing battle, and you're already starting to see, you know, like what kind of got missed in the whole FTX blow up is, right, like the congressional races that have now concluded over the past week, right? And there's nothing super super productive of a gridlocked Congress, right? Like it's going to be a lame duck session for the next 2 years, but you're already starting to see more and more politicians on both sides of the aisle, you know, have the crypto talking points. I think the new House Majority Leader, or sorry, the whip of the House, like pro crypto, and so I think there will be enough people that understand the upside of leading into this tech is greater than trying to squash it when you really can. And then the last bit I would add is that I even saw JP Morgan in an internal note make the point that, right, yeah, the FTX blow up is a centralized finance issue, it's not a DeFi issue. So if they're saying that,
that was nice that they said that, you know, because everybody was just conflating everything together, which is always the most frustrating thing whenever something happens on the centralized side. That it's like, hey, you know, Aave, you know, Uniswap, all these protocols are working just fine. We don't have any issues over there. So it's always frustrating when people lump everything together. But let me ask you this. Before this current Sam wave of collapse and fraud happened, he was in the news for the Eric Voorhees debate. I'm not sure if you saw that.
I
I
did,
gave
yeah.
my commentary on it, and I actually, unfortunately, it doesn't look great now because, hindsight, but I kind of took Sam's side on it in that,
Mm.
Eric was saying, oh, we should just like basically have idealist stance and say, screw the regulators. And Sam was like, that's not how this works. You either go to them with a compromise or they are going to decide for you. And I kind of sided with Sam on that one. And I think he's right, despite, the unfortunate thing that he was fraudulent afterwards. But where do you
Mhm.
stand on that? Like, sorry, the other thing also was on the one of the core arguments was, like you mentioned, that at the block level, we should absolutely fight censorship as much as possible. But on the
Mhm.
front end, if you're a protocol that's offering different products, that you probably should have to get some type of license or something like that, at least in the US. Do you think that is like a reasonable compromise?
Yeah, I mean, I think there's a couple things here. So to answer like the concrete part of that, as someone who has, not for this current project, but for previous work I've been involved in, like, had those regulatory conversations, I think my biggest issue to date is that the stance Sam is pushing in the current regulatory environment is very much a red herring. You can go in and talk to regulators and have your meetings, have your presentations. But the reality is there is not like an actual workable framework, at least in the US, for kind of seeing it through with real action, right? Like this idea that, oh, just come and talk to us, register your project, and you'll be good to go,
Mhm.
does not work. And I think it's very intentional that it does not work. Most US financial regulation over the past 30 years has worked to get rid of this concept of bearer assets, right? This idea that just holding something like a stock certificate can entitle you to, benefiting from it without being registered in a brokerage or something like that. And crypto fundamentally represents digital bearer assets. So I really don't think they want to make it work. Whereas other jurisdictions like Switzerland has FINMA, and they actually have ways for you to register tokens there, right? So that's what kind of makes me side a bit more with Eric, because I understand that there really is no actual mechanism by which you can, really conform to regulators today. Like it really is like this gray area that is, intentionally gray, and it comes from the fact that they like to all tell us to take a hike at the end of the day, right? Like it's just the legal system we have in the US prevents them from outright saying that. But in a more idealistic world, I definitely think like if you locked up, or sorry, not locked up, if you put people together for 6 months in a room, the people that are already doing the policy and advocacy work in DC for crypto, we could totally come up with like a light registration framework, right? Where it's disclosing insider holdings and having regular financial statement reporting, just stuff like that. And if your project does it, then regulated hedge funds and regulated asset managers can hold your assets, use your protocol, etc. Right? Like that could easily be implemented if there is actual political will, in my opinion. And so that's kind of why, like, I think the argument is definitely the way they had their debate was like very much what's the word? Like a barbell, right? Like Eric's a bit too idealist,
Yeah.
Sam was too statist, but the future, I think like a workable future does exist between the two, if that
Yeah.
makes sense.
Yeah.
Yeah.
That's generally, I think I actually said, like, in the podcast, I said the truth probably lies somewhere in the middle. So I would
Yeah.
agree with you on that. Yeah, and to be honest, I have not like read the whole DCCPA and all that stuff, so I don't know all the nuances of the bill and everything. Okay, you kind of alluded to this a little bit. If I were to make you the dictator, well, not dictator, but the just put you in charge of crypto regulation, and I say you form it however you see fit. Like, what do you think is best? Should we create? I think one of the problems too, and I don't know if this is the best solution, but I think it'd be better would be having a completely separate commission instead of having like SEC or CFTC rules applied to crypto, having like a crypto commission. But yeah, if you were like in charge, you get to form the whole thing. What would your ideal framework look like?
Again, I'm not a lawyer, but I think the primary constraint that I see at this point in time is the fact that so much of financial regulation, both in the US and outside, presumes the existence of an intermediary for these types of transactions, right? Like, I think you saw that with like the Uki DAO CFTC stuff, right? What they really honed in on was the fact that the Uki protocol, or BZX, whatever you want to call it, was offering leverage, like so many apps in DeFi do, right? Like, it's not a good fact pattern for any of us, but was not registered as a proper broker for doing so. I don't know what the actual terminology there would be. And so to your point, right, like, do we need a new agency? I would say, while you could make crypto conform into existing ones, right, like, I think we would all be better off if some of these DeFi governance tokens were securities and had cash flow, return to people and all that stuff. But like, the fact that we can just transact these without intermediaries and can collateralize them where we want, for more fun, just throws a wrench into making any of that stuff like feasible. Because the issue for the SEC or the CFTC is, they finally come up with like crypto frameworks, and then now every traditional company realizes those frameworks are a bit more lenient than what they've been having to do for their own shares, right? And now you just like stir up a $27 trillion capital market here in the US with regulatory uncertainty, right? Like, I think that's the primary reason we have not seen any meaningful, guidelines or frameworks or registration processes. And so, kind of with that in mind, I do think it would beget the need for a new agency, but that agency can't just throw out what the other agencies have been doing in their respective spheres. So that's why I see it very much being something that's between a rock and a hard place. And I mean, I personally wish there were a better answer, but like, I don't know if the US is ready to lead on this as a result, right? Like, even the EU is starting to have better stablecoin legislation and regulation than the US is, which is just like totally opposite of general tech trends over the past 20 years, right? The EU has been kind of lagging and ineffective on that front. So
yeah. Do you think that like okay, smart contracts, like, because you mentioned like so much is based on intermediaries, and one of the reasons, like, especially after 2008, right, like they increased the regulations on hedge funds as far as disclosures and all these things because of Bernie Madoff type people, right? You can't just not say anything about what you hold, and I think that's reasonable. I think if you're holding other people's money, that you probably should have a certain level of like transparency, and obviously protocols have that through on-chain transparency. But I think a tricky part, like you mentioned, is like when you put money in a smart contract, is that custody? I don't think it is, but I think regulators could certainly make an argument that it is, right? Because you could say, well, if you have an Anon founder, because it's happened, right? Anon founders will steal money out of smart contracts, right? And it's like, what's the recourse for that? Is that something that would ever really be allowed? Like, let's start with one question first. Just smart contracts. Do you think that will end up being seen as a form of custody or not?
I think there's two ways you could go about it. I think if we did have like a industry developed framework for registering crypto projects at like a regulatory level, I do think you could implement checks for making sure that, if a project registers, they have to make certain commitments around emergency powers over a smart contract or backdoors in a smart contract, right? Like, that's mean, definitely doable, right? You can never say a smart contract is not hackable, but like there are certain checks you can implement to make sure, you know, people can't move deposited assets. And I mean, I do think there's precedent for that, right? Like if you work in professional services, right? You see these like SOC 1, SOC 2 type of audit tests. There's that for both finance and for cybersecurity, like enterprise tech implementations, right? So I do think there is a path forward on that, where we don't necessarily have to make a legal opinion on whether smart contracts constitute custody. I think you could just implement specific standards for smart contracts. And then, you know, if you tell regulated asset managers that they can only interact with smart contracts that are registered, then liquidity, you know, becomes the deciding factor at the end of the day. Liquidity will not go to unregistered smart contracts, and it solves your problem, right? Flip side would be similar to those conversations around like wrapping DAOs and legal entities, which I'm not a fan of personally, but you could make the argument that maybe a smart contract has to be associated with a legal entity or something like that for it to be registered. And that could, you know, introduce a more fiduciary relationship between the deployer and the contract. And again, right, like if that's the prerequisite for getting a specific license or a specific rating, maybe Moody's is doing this in a decade, right? Then liquidity solves your problems, because liquidity will not be going to unregistered smart contracts in that event. So I think there's like a couple ways to think about it, and I don't think it will require necessarily like 80-year-olds to make legislation that defines this type of stuff, right? Like because there just are these precedents in both financial services and enterprise tech, you know, where we have implemented standardized checks and tests for kind of assessing the robustness of a given architecture, right?
Yeah, that would be, yeah, that's interesting. I know what you're talking about with SOC. I'm not super familiar with how that works, but I get what you're saying with having a certain checklist, essentially, of like, if it doesn't meet the standard, US institutions or whoever are not allowed to invest in it, rather than, like you said, making it considering it custody at a legal level. On the non-founder part, I go back and forth on this, because the problem is, it's like, I mean, Sam wasn't an Anon, you know, like, and he was committing mass fraud. Does the Anon founder thing, that's like a major trope that non-crypto people definitely have a target on, right? And obviously you're a protocol founder and you're not Anon. Where do you think it ends? Do you think Anon founders will ever be a thing, or not in the US?
I mean, I personally wish I had been Anon to begin with. I think the upsides of being doxed in today's, you know, like today's crypto landscape are relatively limited. Like, I do think Anon founders can figure out funding and, you know, get people to work for them. It's, you know, we see that with like you're in finance, right? Obviously Andre was doxed, but most of the remaining team is not, and that has not impeded them in the slightest, right? I guess I don't make any like moral kind of decisions about that, right? Like, I don't trust anyone more or less, whether they're Anon or not, just because, like you said, I think every single major blow up this year came from docs, founders and,
Right.
and fund managers, right? So, but again, right, if we go back to this idea that the future is some form of registration, even if it's light-handed registration, I do think one of the prerequisites will be, you know, having names and addresses for lawsuits to get sent to it. Like, that's just how these things work. Maybe you can get around it. Maybe, you know, Anon founders have to put up bonds that can be sued against. You know, like I think that may have precedent in other career paths, but right, like at the end of the day, you know, no one can stop you from deploying that contract, right? And so it becomes more of a spectrum in my mind. It's like, you know, what is the glass ceiling for non-founders versus like this binary thing?
Yeah, I don't think the Anon founder will ever go away. It's more like, I think, you know, if we're fast forwarding 5-10 years from now, I think it's very unlikely that you'll ever see a major institution working with an Anon founder. I think it's just probably not very feasible. You know, like when we talk about if a BNY Mellon or Fidelity or whoever is going to like have some type of product, I highly doubt that they're going to be able to pull off working with an Anon founder project, right? They're only going to work with Doxed founders. Right or wrong, I think that's probably where it ends up. But yeah, I agree. Like I used to lean a little more towards, like once you get to a certain level, like if you're just starting a project and it's small and whatever, I don't think you need to be doxxed. For me, it's more like, okay, if you're getting into the hundreds of millions or billions of dollars of assets, probably should be doxxed. Now, in that case, often in all reality, I think a lot of these people, you can find out who they are. It gets harder at those levels, but like I don't see a world where Fidelity is going to like put $1 billion in a protocol within a non-founder. I just think that's probably not going to happen.
Right. And I mean, there's also the reality too that, you know, there's founder, like sure there may be founders, but the reality is like a lot of these projects are more so the sum of their parts in terms of like who's contributing. Yeah. And so if you have 3 names and 3 addresses, but 30 Anon contributors, right? Like that's not necessarily going to be a problem, right? I mean, frankly, like think about all of the software that's, or all the open source software that's getting used, you know, across tech and finance today. Finance less so, but you know, like Linux is used by
right,
so many people or so many businesses, and you know, you don't have an expectation of knowing who the maintainers are necessarily, right? So,
right.
I think there's definitely a path forward. I don't think we have to be in some like dystopic, like everyone has to have a license type future, but you know, someone's head has to be on a chopping block.
Right. That's where it gets tricky, right? Because I agree. You probably don't need to have every single person in an organization, but if you have 30 people and 3 of them are the doxed faces and the rest aren't, and then some of the Anon people do something that screws over the protocol, then you know that sucks if you're the dox person that has to put in the chopping block for that. So yeah, unfortunately, I don't think there's an easy answer. Like everything difficult in life. I really hope that regulators aren't gonna be so aggressive. I'll be honest, I was more optimistic before this FTX stuff happened. Now I am less optimistic. I haven't like thought enough about what I think is gonna happen, but anyways, let's move on from the regulation talk. It was good to get your insight on that. As far as like general markets, not giving any financial advice, anything like that. How do you see things right now? Like, we'll start with just like ETH itself, since you're a DeFi founder. Like, do you think ETH is reasonably close to the bottom here, or do you think we have a lot more to go?
I think the one outstanding thing for me is just knowing where the contagion stops. I think that's most people's main concern at the moment, right? Like, I don't know, people are murmuring about Jump, right? Because they've been quiet for the past few weeks, and now Genesis having gone under, right? I think Silvergate is more on the Bitcoin side, but that's another like shoe to drop potentially. But the fact that we did, you know, finally go negative for a hot second on ETH emissions since the merge during all the FTX volatility is just like such a, I don't know, it's such a clear narrative for how the next cycle can start, in my opinion, right? Like we went through 2018 and we went through 2019 because, you know, there's millions of dollars of ETH getting dumped every day from miners at the time. And it's just a very different asset now, right? Obviously, staking rewards being yield is, you know, I don't think that holds up under too much scrutiny, but the MEV is real. The lack of net new emissions sometimes is real. And I think you can, like that JP Morgan comment we referenced earlier here on the call, right? Like, I think that's them kind of tipping their hand a little bit. I would assume ETH is going to be like the institutional grade asset of choice.
Yeah.
Going forward, especially just if maybe ESG takes a back seat given like the whole, you know, natural resources
Shortage.
Shortage that we're all going through, right? So maybe, but even if that's the case, right, and maybe people are willing to put ESG aside, Bitcoin mining is still a massive electrical burden on a regional level, right? And so I just find it hard to come up with like really great Bitcoin bull cases. Obviously, like I'm not going to call it dead. I'm sure it will continue chugging along, and there'll always be another Michael Saylor. But I'm perfectly content just, you know, accumulating ETH and seeing it get recognized as like this neutral financial settlements layer going forward. Oh, you know, censorship is still like a big concern for me, but it's, you know, you're not going to get any less censorship on another chain, right? So
yeah, I've been thinking about this too with the regulation side. I think there's like now, I think there's a huge advantage to have already been an established chain. Like I think it's gonna get increasingly harder to try to launch. Like if you're trying to be a Ethereum competitor launching today, it's gonna be way harder. I think the lendiness factor, right? like might be a big deal. Do you think?
Sorry, I was just gonna say I strongly agree with that. Like one the things that make me so bearish on things like Solana and, you know, Cosmos DApp chains, for example, despite super vibrant builder communities happening there, is like people forget that like the real advantage of ETH is just like it's a bookie that doesn't need a gang protecting it. I've been watching a lot of PE miners lately, so kind of has been informing that view, right? But it's like it managed to scale its validator set to the point where it's distributed enough, and everyone validating transactions has plausible deniability, right? Like, you know, if you're validating transactions for the DYDX chain, like no way in hell are you going to be able to say, oh, I'm not, you know, a financial money transmitter or whatever the, you know, relevant like regulation would be in that case, or, you know, I'm not a derivatives settler. It just like does not hold up at all. Or something like Solana, right, where the technical demands of running a validator are just so immense, right? You're never going to be able to do that like in a sufficiently decentralized way. And so I think that's what's really getting lost in the narratives these days, especially with like the whole DApp chain kind of resurgence, at least from the thought leaders at the moment.
Yeah, and if I'm defending Bitcoin, since we've mentioned that, I think that's the biggest advantage Bitcoin has, right? It's just it's the most lindy coin. It does have a true Anon founder that hopefully will never be discovered. I don't think it will be, or at least officially, you know, we can speculate, but and that it's like its own thing. I think ETH going proof of stake finally is actually good for Bitcoin long term. Whether the flipping happens or not, I don't know. I lean towards yes, but I wouldn't like bet my life on it. But I think Bitcoin being its own thing and staying proof of work and just being this Lindy, like digital gold type thing, that you're not going to be able to create another Bitcoin, right? Like that, I think is pretty clear. That will never happen again. So that's like what it has going for it. And I think that ETH and Bitcoin being the dominant chains is probably pretty established at this point. Like I would see I agree with you. I think it's like the idea of someone flipping ETH, I think is extremely unlikely in terms of like trying to be another settlement layer for dApps and all of this. I'm not saying that like I'm still like, as far as from a pure investing betting standpoint, like this morning I actually bought some Solana because it was like $13.
Sure,
I was like,
yeah.
I was like $13, you know, I'll punt on Solana here, you know, but that doesn't, I still put like the odds of them never reaching new all-time highs at like I would say greater than 50% at this point, right? Especially obviously with Sam's full involvement, but it's crypto, so you never know.
Right. And just
but
because things can't like become an Ethereum competitor doesn't mean they can't become an Ethereum roll up
yeah,
or an Ethereum side chain, you know, in some way or form, right? And find success that way. But to your point, right, like how do you value that, especially when block space is pretty plentiful these days? Like, you know, I don't think anyone has
right.
really good answers to that just yet.
Yeah, like I mean, even Anatoly himself has talked about like there's definitely a world where Solana just becomes an L2 for ETH, right? Because they're just like this rapid execution layer, and yeah, they'll be more centralized than other people, but for the types of applications like he's mentioned, it's a little cliche, but like kind of the decentralized NASDAQ or pseudo decentralized NASDAQ type thing. Like I think that's reasonable, and that's a path that I think if they want to succeed, they should probably push more too. Now, of course, with Serum getting screwed and all this, they're in a tough spot. They're in a tough spot. I feel bad for the people in the Solana community. I know a lot of those guys, but anyways, on ETH, what like we're talking again, not financial advice, but are there any DeFi protocol tokens that you like here at all? I know it's tough. They've been down only for a long time, but are there any that you think have a chance?
I think we as an industry have to kind of recalibrate how we use our tokens and treat our tokens first, to be quite honest. Like, I think I'd be comfortable like stating which projects I think have like good futures ahead of them, right? Like I think the work being done over at Aave has been like lights out for quite some time now, and their expansion into like social networking with Lens as well, like I think really kind of highlights that they're thinking about things well. And also, you know, I think the real world asset space is the ultimate end game for DeFi liquidity, and projects like Centrifuge are really pushing the needle on that. And so I'm bullish on DeFi projects, but I do recognize like we very much have been building with both arms behind our back, both in terms of the product and both in terms of like the tokens associated with these projects. Certain jurisdictions do get a bit more leeway, right? Like I think Maple gives token revenue back, or gives protocol revenue back to token holders. But everyone else has kind of had to like look the other way on that type of stuff. So there's that element. And then when it comes to what these DeFi protocols are actually doing, right? Like, you know, I think people, I mean, I even saw a tweet today from someone at Paradigm talking about how like DeFi sucks. And it's like, well, yeah, but like if I wanted to launch home mortgages on the blockchain tomorrow, right? I'd have my door kicked in within a week, right? Like it's just,
Right.
you're not playing on a level playing field. So yeah.
Let me tell you, you know, when you do so much crypto, you forget how slow TradFi is. Like I just yesterday I had some money on a traditional like stock brokerage and I want to buy more crypto. So I said, okay, I'm gonna move it. And so I sold a couple things, and it's like, oh, you sold that, but you're not allowed to actually withdraw for 3 days. And then once you withdraw, it's got to go to your bank. That's going to take another couple of days. And then I need to move it over to who I was using FTX US before for my on off ramp. So I'm gonna have to maybe go to Coinbase or something now. But like then it's like, okay, so I wanted to just like sell some assets here and buy them here, and it's gonna take me at least a week to make that happen. Like we forget how I'm used to just like, oh, cool, I want to buy something on Polygon. Let me just bridge over real quick. Okay, 2 minutes later, done. You know, that is like the speed we really underestimate, I think. And I agree, like on the real world asset thing, like it's not DeFi founders' fault. You know, it's like it's just like an impossible problem right now. By the way, you mentioned Maple. Side note, I one thing that made me bullish a little more on them recently was I saw that a few weeks before all this FTX Alameda stuff happened, they stopped lending to Alameda because they had like red flags and they said we don't want to lend to Alameda anymore. I don't know if you caught that. That was, it's like okay, good for Maple. speaking of real world assets, what do you think about what Maker is doing right now?
Yeah, I mean, I think it's a tricky situation. I've seen, so I guess for the listeners who don't know, right, like there's currently a $200 million real world asset proposal going through MakerDAO governance. And, you know, one of the main criticisms there has been that pricing of that credit facility is pretty whack. I think it's like 4% for the credit, you know, like we're talking like that's like government yield, right? Sovereign
Right.
debt yield. And so, you know, my biased view, right? Like as someone who is building out a separate stablecoin protocol, who is looking to get into like credit markets as well with our V2, is like people have to be able to differentiate between a protocol and the implementation of that protocol, right? Like MakerDAO is, or the Maker system is a protocol for, you know, creating a stable coin, but the MakerDAO implementation has its own politics. It has its own decision makers, and you know, comparing that to traditional financial institutions, it doesn't work, right? Like imagine if a bank had to have forum conversations for every financing decision it had to make, right? Like it just is not at all scalable, despite being an internet native system. And then now you have all these concerns about like the quality of due diligence being done on these proposals, right? Because like that one's going through centrifuge as well, right? So like I'm a fan of all the players involved there, but like the execution of how it's going down is frankly a bit questionable, right? And so I think what we're missing in DeFi, well, not missing, I think Maple is on the right track here, but like having protocols for marketplaces, I think is far more important than having protocols for, you know, specific instantiations, right? Same with Aave, right? Like you onboard one piece of shit collateral and now the whole system is like teetering.
Yeah.
Whereas in the real world, if a bank makes a few bad loans, right, it doesn't automatically blow up, right? Like that's built into everything. And so that's kind of like my hope, you know, when it comes to like the future of DeFi, is that everyone kind of like does a little bit of self-reflection and maybe looks to take a more marketplace-based approach, like, you know, like how Maple does with its credit delegates, right? Like I think the example you cited, it was like orthogonal trading that really like signaled the alarms, right? Like they did a good job there. Maybe there had been another credit delegate who didn't do that, right?
Mm-hmm.
And they would have blown up this past week, but Maple would be fine, right? So I think that's kind of my view on DeFi at the moment. It's like we need to get more to those types of systems, which are actual protocols that allow for, you know, kind of robust marketplaces to form, and that do allow for credit failures, that do allow for misjudgment of risk. Because today what we've really just accomplished are, you know, bring DeFi liquidity in, but still have key man risk in who is deciding what gets to be collateral, because it all has to be a unitranche you know, system, right? Like Maker, like one bad piece of collateral, it's not great. Yeah.
How do you feel about, like, obviously I think one thing that DeFi needs to be a little more open to is learning some of the lessons from TradFi, as much as we might want to be our own thing. Like one thing that kind of baffles me, like when you see like Mango Markets type thing with the exploit, like you're discussing, or yeah, you could just, you know, one bad piece of collateral on Aave, you could take it down theoretically. Like there's a reason why TradFi has like stop gaps and circuit breakers and things like this. And I know that it's like the pure decentralization is you don't want to have those things, but I think you're not really affecting any normal person when you're saying if someone's trying to borrow more than $20 million, they need to have like extra layers through it. I don't think that's like an unreasonable thing to say. Do you think we're going to start seeing a lot more of that in DeFi?
I mean, I think we have to. Like, there's no other way we scale. I think, you know, seeing things like that Mango Markets exploit that happened, I think it speaks more to the fact that so much of this got built in 2018, 2019, when we didn't have the same degree of, how do I put it? Like when Compound was building its first lending market, it had to assume it was existing in a vacuum, right? Like this has to be a completely self-sufficient thing. And then, you know, time went on and DeFi popped up on Solana. So people, you know, started building Solana versions of those earlier Ethereum platforms. And now we're in 2022, where, you know, you combine this like toxic cocktail of people not caring because it's a bear market, right? Like no one's like, few people are actively monitoring like the status of collateral that got added to Aave or Compound 2.5 years ago, until someone like rings the bell, right? Like Kirk over at Volt Protocol like rang the bell for a few governance tokens that were listed on Compound. Someone just did it for Mana on Aave, right? And so they're finally like cleaning that stuff out now, or sorry, not cleaning it up, but you know, readjusting parameters and all that stuff, right?
Yeah. Like the other day when Alameda collapsed, they basically run Ren, and you know all these lots of protocols use Ren, and I was looking around, like even like Aave had a Ren file coin market, and I was like, they should probably get rid of this, you know. I mean, and you saw on Solana, right? What was it, Solet, BTC and ETH?
Solana, yeah,
just basically went to zero because it was like they had that, it was supposedly backed 1-to-1 by Alameda assets, and then once Alameda is like going under, people are like, okay, well now the BTC is trading at like $1,000 or something, right? And that's a disaster, you know. That's how these things happen. Yeah, sorry, keep going.
No, I was just gonna, I mean, I think that's a good cap to it, right? Like for these protocols to really scale, like not only do we have to have you know, a bit more sophistication on how we think of collateral, which is already happening, right? Like Gauntlet does a lot of great work on that. And I'm sure we'll be able to like implement like different protocol features that can express that a bit better. But like also the time involved in reassessing collateral has to get a lot better, right? Like you can't have a forum post asking for the interest rate to change on a moment's notice, right? Like that type of stuff has to be programmatic, in my opinion. Like otherwise you just open yourself up to like being a very bad bank at the end of the day, like a poor alternative to a bank. I mean, that's ultimately what we're not trying to be, right? So yeah, lessons were definitely learned, I think, over the past few months on understanding collateral.
Yeah, I agree. I will say though, on the positive side, I think the market is very good at reacting to things. I think that's one thing that crypto has shown, is that it's extremely resilient, and we tend to learn. Maybe I'm not saying we don't make repeat mistakes, but we definitely learn a lot of lessons. Let's pivot a little bit to what you guys are working on at Fiat DAO. You had a new launch recently that unfortunately went under the radar a little just because of everything going on. But you want to talk about that a little bit?
Yeah, sure. So for the folks who aren't familiar, Fiat V1 was basically a maker fork with some extensions, specifically for accepting fixed income assets. So you have USDC locked up for 6 months. We'll take that as collateral, give you high LTV, and actively reassess the risk of that collateral as it converges upon its maturity. Now we launched that in April. So yields collapsed, not able to really monetize any liquidity. And so we've kind of just been heads down building. And a week and a half ago, we announced basically our plans for Fiat V2. Fiat V2 is a technical upgrade, but it's a very significant narrative pivot on our end. Because with Fiat V1, we said fixed income assets only. There's like 6 projects that you can integrate with that. But because we were working on illiquid collateral and now volatile illiquid collateral, which is kind of what led to the Fiat V2 genesis, basically, we realized that what we had been building is actually conducive to any lending arrangement you can think of. And so our goal with the Fiat V2 is, very heavy caveat on this, but like a permissionless stablecoin. And the way we're going about that is basically rethinking our protocol as a credit marketplace. And so the very simple TLDR, I'm working on content that boils down the white paper a bit more, but is that you can have a permissioned list of assets that are deemed high quality collateral. So stable coins, ETH, interest-bearing positions in either, right? And actually use those permissioned assets to vouch for collateral vaults that were deployed by anyone. And so the idea is kind of similar to how Liquidity, allows you to deposit LUSD and liquidate positions as they get, as they violate collateral requirements. Mm-hmm. Here we're saying you don't even have to mint the stablecoin. We'll value your deposit in ETH. You can choose which borrowing vaults, this is the term we use, you want to underwrite. And now your fiat credit is being used to actually liquidate positions automatically. That's kind of like the first wave of defense. And so there's a lot to unpack there. I think the most important things to highlight with it are not only does it allow for like fiat to be minted against fixed income assets like we've been working on, but you could even imagine unsecured credit lines. Similar to like what Maple has been facilitating, where if people delegate $1,000 to who's left standing, Wintermute, right? Then Wintermute can have 1,000 fiat credit line and mint that, and if they don't repay based off of whatever the specifications are for default, okay, then we take the people who vouched for Wintermute, we take their good collateral because it's USDC, it's whatever. So that's what excites me the most. I think there's a ton that can be built on top of that structure. And yeah, I think makes sense in terms of what we were talking about earlier, where you want to build something that can withstand failures and can have like a market-driven approach to interest rates, debt ceilings, and those types of parameters.
If for the underwriters, I know you can't estimate this exactly, but like what roughly yield do you think people would be able to generate on like an example like that, like a Wintermute or someone pretty established that wouldn't consider to be that risky, though who knows these days, but
yeah. So I think this is where it gets fun, right? Because let's take a Wintermute example, right? Wintermute has been borrowing on Maple, I'm pretty sure unsecured. Like they haven't been putting up collateral, at least recently. And they've been paying 12%, right? But you have to keep in mind that 12% takes into a number of factors, right? It takes into account the risk of Wintermute not repaying, but it also is the risk of Maple not attracting enough USDC to lend to Wintermute in the first place, right? Like you have to bring people through the door. And they do that in part with Maple token emissions as well. And so now, right, with the fiat system, right, if I can put up staked ETH, if I can put up Frax convex, blah, 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 right? Whatever the derivative is as a reserve asset, then the amount of yield I, would request of Wintermute before delegating to them, I do think it goes lower, right? Like your opportunity cost looks different. And so that's the primary thesis for why a stable coin and a credit marketplace go together so well, right? You don't have to pay for people to bring the USDC to the platform. You may have to pay for that stable coin of yours to have liquidity. That's a whole other conversation. But at scale, all else being equal, like it's always going to be cheaper to have your own money, right? It's kind of like the banking thesis in a nutshell. So there's that element, right? The other element here is that for other assets, like actual assets, I think fixed income in particular is intriguing because there you don't need a ton of backup liquidation support, right? So like if you have locked up USDC for 6 months, we wouldn't require like a 1-to-1 ratio of credit delegated to mint against that. it would, I think, look a lot similar to how, banking regulations try to go for 10 to 20% liquidity buffers. So if 100 fiat delegated to a fixed income asset allow people to mint 1,000 fiat against $1,000 worth of that fixed income asset, now you're passing on 10x levered yield. So the interest rate can be very low for that person to mint fiat against their fixed income asset, but it comes through as like a still competitive yield, to the underwriters. 40 basis points becomes, 400 basis points in that example. So, yeah.
And would you, like we were talking before about managing risk, like, are you, how are you like segregating risk between these different markets so that if one goes bad, it doesn't affect everything else?
Right. So there's two sides to that, right? There's reserve asset failure and there's borrowing vault failure. I think on the borrowing vault side, right, this is the unpermissioned side of the house. Whenever one of those things gets deployed, there would be a one-to-one limit enforced. So like if you, launch David Coin as a scam and try to run the protocol, you'd only be running.
It's a very legitimate project. Okay, David Coin, it's got good prospects. All right.
Yeah, that's fair. Everything looks like a rug pull on CoinGecko these days, right? But just the like long tail assets, whatever it may be, and the ability to go above 100% utilization of that delegated credit, that then becomes a governance question. So basically, those people that are underwriting, they're the first line of defense. Second line of defense would be your generic collateral auction, right? Like how Maker does it, how Aave does it, right? Like those kind of usual mechanisms. And then fallbacks actually become, protocol issuing debt to cover, like the protocol issuing bonds to cover bad debts and so on, right? So in that sense, what we're introducing is just another level of collateral liquidation mechanisms. And again, that's not going to be perfect, right? Like the parameterization of the system will be very important. It'll be very important that random long tail things don't represent 10% of outstanding collateral backing supply, right? Like that's reality in my opinion. It's not ever going to be something totally autonomous, but I think that's okay, right? My opinion is, even if you can only get 10% LTV against your long tail collateral, that's better than nothing. There's a market for it. And like we're building this to be scalable such that it doesn't cost the protocol anything to onboard hundreds of different assets, even if we're talking about like 1 million TVL here, 1 million TVL there, right? And on the reserve asset side, right, like if you onboard some interest-bearing position and Lido goes belly up or whatever it may be, there are ways to attract more capital to basically patch those holes. It's a bit different because fiat never got minted against those positions. You're only kind of shoring up the commitments they had, like the insurance fund basically is what we're talking about there. So we have like a few modules in place for that as well. So nothing's ever going to be airtight, but we do think the system is a bit more robust and is a bit less dependent on manual intervention for those types of triage scenarios, because you have this enlisted capital that is willing and able to liquidate on command as needed, by virtue of underwriting.
Do you guys do partial or like full liquidations?
Well, like we're still, yeah.
Like say Wintermute. I'm not trying to say anything bad about Wintermute. Wintermute's good, but I was just saying, as the theoretical, like say they have like a monthly payment that they have to, or whatever, how it works, right? A monthly payment, and they miss that monthly payment. Are you doing a full liquidation or only a little bit of it?
So that's a good point, right? Like I think the main answer for that is basically we would not have a canonical implementation for a borrowing vault. I think for the Wintermute example, we would have something like you just laid out, where default is defined by, you didn't make your minimum credit card payment, right? Like that type of thing. And in that case, it becomes just a matter of repaying what you've, maybe your missed payments, right? Like that type of concept, I think. But ultimately, right, like the main fallback there would just be to cancel the borrowing fault, like you would cancel a credit line in the real world, and seize the assets of those users who had vouched for that credit line in the first place. So ironically, those types of arrangements are actually less risky to the protocol, right? Because if we enforce a one-to-one requirement, then we'll always have collateral to seize. It's the things that would keep me up at night are when you have fixed income derivatives, where they're very low risk 99% of the time, but a smart contract hack could send them to zero. And maybe you only had 10%, 15% of the collateral value backed by our liquidation buffer system, right? Because you assume that the USDC locked up in one of these protocols was fine, but then went out the window. That's far more concerning. I think that's where insurance has to come into play. Other hedging mechanisms have to come into play, right? Like Y2K finance, I think is a good example of like the types of infrastructure that'll need to exist for those arrangements to scale. But yeah, there's a large attack surface, but I do think at least taking a marketplace approach is more robust for those types of events.
And a final question for you. Yes. It's running a little over time here. I'll let you go in a minute. If I wanted to, how do I frame this? If I wanted to create a way where I could use real world treasuries as collateral, do you think that would be possible within like 2 or 3 years? And how do you think it would be possible if it were?
Yeah, so my understanding at the moment, having like spoken with folks working on this, is it's primarily it's a tax withholding issue at the moment. Like the people who are trying to tokenize treasuries, you have to incorporate it basically as a bond ETF, and that comes with weird restrictions just off the get-go, even if you do it in a favorable jurisdiction. Then even if you get that off the ground, then the question becomes, ERC-20s getting transferred without KYC, right? Like a bit, could be a red flag, right? I think somebody will crack it. I mean, the question will be whether interest rates are still appealing in 2 years. That's.
I still think whether they are or not, I think having treasuries on chain is like one of the ultimate wins for DeFi, just because they're such like they're like the bedrock of the global economy in many ways. So being able to figure out how to get them on chain, I think is like, I think it should be a goal for DeFi in the next like whatever 5 years. I could see it being like a Fidelity type thing where maybe like some centralized entity ends up doing it and they like have the approval of regulators to like, okay, you can make like maybe you could do it'd be weird. Like the transfer thing is very tough, right? Without KYC. I don't think the government's gonna want that. You could do like, I don't think it would work, but like some type of like you have a specific wallet with a soul bound, like non-transferable treasury. I don't know. Yeah, that wouldn't, I don't know. It's not an easy answer. But yeah, I think that should be like, that should be like one of the main goals. Because then if you can do that, you can probably do most real world assets. I think that's kind of.
Yeah, and I think it's also something that could be led by weaker countries, right? Like if we are going into a sovereign debt crisis, I think more desperate countries will be willing to like tap any liquidity they can find, regardless if Uncle Sam like comes knocking later, right? So maybe we see like tokenized emerging market sovereign debt in the next 2 years. I guess El Salvador kind of came close. They didn't really do that, but it showed a willingness at the lower rating levels for that type of behavior. But yeah, I mean, to your point, right? This is all kind of inevitable. It really just is, is it 2 years, 5 years, or 10 years? Like, eventually our generation will be the ones making these regulatory decisions, and
Yeah.
we'll have a totally different outlook on this type of stuff.
Yeah. I just don't want to be 80 when it happens. I'd like it to happen a little sooner, but
right.
All right. Well, this was great. Thanks so much for your time. If people want to follow you, where can they find you?
So I'm on Twitter, chronically, and it's just last name underscore first name. So we can put that in the show notes, I guess.
I will. I'll put all your links. Twitter. I'll put links to Fiat DAO's Twitter as well if people want to check that out. Good luck. I really like your approach. I like having you on because I think you have good insights. So I'll happily have you on again whenever you want. Yeah. Have a good one, man. Thanks so much.
Awesome. Thanks so much, David.